Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about WEICHAI Power interim report. WEICHAI Power Co. Limited offers a diverse range of products and services across various industries. The company's business segments include engine manufacturing, producing truck, bus, construction machinery, industrial and power kit engine, products commercial vehicle and auto parts production transmission, and axle manufacturing aftermarket products, including parts, oil, and remanufacture forklift production and warehouse technology services, supply chain solution, services industrial truck and materials handling services. The company operates under several brands, including WEICHAI Power Engine, Fast Gear Transmission, Hand Axle, Shanxi Automobile Heavy Truck, and WEICHAI Level Smart Agriculture. WEICHAI Power's stock price has increased by approximately 22.37% over the past year due to several key factors. The company's strong financial performance, with a 6% year-on-year increase in income and a 51.4% year-on-year increase in net profit attributable to shareholders, has been a significant contributor. Additionally, WEICHAI Power's accelerated earnings growth and improved margins have outpaced the broader machinery industry. The company's positive market trends and sales figures have also played a role in its stock price growth. Total engine sales volume grew by 9.8% year-on-year in the first half of 2024, with strong market shares maintained in heavy-duty truck engines and LNG heavy-duty truck engines. The surge in heavy-duty truck sales in August 2025, up approximately 40% year-on-year, has also boosted investor confidence. Furthermore, WEICHAI Power's commitment to environmental, social, and governance (ESG) practices has been strengthened through the formation of a new committee in August 2025. This move is likely to have positively impacted shareholder confidence and contributed to the company's stock price growth. Overall, WEICHAI Power's strong financial performance, positive market trends, and commitment to ESG practices have all contributed to its increased stock price over the past year. The primary drivers of revenue growth or decline can be identified from the financial summary. On one hand, significant increases in receivable financing for companies such as Sinatruck, Jinan, Aftersales and Intelligence Services Co., Limited, 463%, Shantui Construction Machinery Co., Limited, 306%, Zhongtong Bus Holding Co., Limited, 131%, and WEICHAI New Energy Commercial Vehicle Co., Limited, 244%. Contributed to revenue growth. Additionally, increases in contracted commitments for acquisition and construction of long-term assets and outstanding acceptance bills from distributors also boosted revenue. On the other hand, companies such as Sinatruck Jinan Truck Co., Limited, and Sinatruck Jinan Commercial Truck Co., Limited, experienced significant decreases in accounts receivable, leading to revenue decline. The motors segment also saw a 2.8% decline in revenue from 2024 to 2025. While the components segment showed an 8.1% growth during the same period. Overall, these factors highlight the key drivers of revenue growth and decline for the companies involved. Net income and profit margins. A shift in fortune. The financial summary reveals a mixed bag of results for net income and profit margins. Initially, net income saw a significant increase of RMB 438 million due to substantial foreign exchange gains. However, this trend was short-lived, as net income decreased by approximately RMB 811 million, resulting in an 11% drop from the previous year. Profit margins also experienced fluctuations. The gross operating margin increased by 0.4 percentage points to 22.2%, but other metrics tell a different story. Operating profit and net profit margins both declined, dropping from 8.94% and 9.16% in 2024 to 6.63% and 7.35% in 2025, respectively. The decrease in operating and net profit margins can be attributed to various factors, including the impact of foreign exchange gains on net income. Despite these setbacks, the gross operating margin's slight increase suggests that the company is making strides in optimizing its operational efficiency. The company is generating positive operating cash flow, as evident from the numerous references to net cash inflows from operating activities in various pages of the financial summary. The data points consistently show a significant increase in operating cash flow from 2024 to 2025, with a notable rise in cash at bank and on hand. This indicates that the company is successfully managing its finances and generating sufficient cash to cover its operational expenses, resulting in positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past period. While interest expenses have generally decreased or remained relatively stable in most cases, there are notable exceptions. For instance, on page 212, interest expenses increased by plus 114.6%. Additionally, long-term borrowings due within 1 year decreased, while total non-current liabilities due within 1 year increased, page 214. However, short-term loans and long-term borrowings due within 1 year increased, while long-term borrowings decreased, page 244. Overall, the company's debt level has seen fluctuations, with some periods experiencing significant decreases or increases. Regional performance review: the company's financial performance varied across different regions and segments in the given period. Notably, overseas markets showed significant growth with further development, while the domestic market experienced a revenue increase of 0.6% compared to the previous year. Region 1 was another area of success, with a substantial revenue increase of plus 6,837,576,497.74 in 2025, contrasting with a decline of minus 5,964,914,787.37 from 2024. The automobile and agricultural equipment segments also performed well, generating significant revenue. However, not all regions and segments fared equally well. Overseas business segments experienced a slight year-on-year decline due to decreased demand and order volumes. Intelligent logistics was another underperforming segment, with a substantial loss of minus 405,252,362.15 RMB. Management's outlook and strategy: the company's management is optimistic about its future prospects, driven by several key initiatives. Firstly, they plan to utilize funds raised from non-public A shares issuance to invest in specific projects, replenish working capital, and enhance the group's capital capability. Furthermore, management is committed to expanding the company's global market presence through SOFC technology development. To achieve this, they are adjusting production capacity planning, increasing R&D investments, and implementing upgrades for product differentiation advantages. Additionally, management aims to drive growth through domestic infrastructure investment and equipment renewal policies, while also boosting exports and achieving exponential growth in export volume. They remain committed to their full-year targets and plan to drive innovation-driven growth with technological breakthroughs. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In the given financial summary, it is clear that the company has paid dividends in both periods, with a total distribution of RMB 3,021,200,582.59 in 2025 and RMB 2,554,245,459.73 in the previous period. Additionally, the company has also engaged in share buybacks, with an amount of RMB 99,987,513.55 spent on repurchasing shares in 2025. This demonstrates a commitment to rewarding shareholders through both cash dividends and strategic capital allocation. Concerns about inventory buildup and potential supply chain issues: the financial summary highlights concerns regarding inventory buildup, which may indicate potential issues with supply chain management. The increase in raw materials inventory by 11.9% from December 2024 to June 2025, page 184, suggests that the company is holding more stock than necessary. Additionally, the rise in finished goods and OEM materials inventories, page 185, further supports this concern. The cost of sales for the intelligent logistics segment being significantly higher than revenue, page 232, may be attributed to inventory-related costs. The increase in freight and packaging expenses by 11%, page 234, also points towards potential issues with inventory management. While there are no specific concerns about supply chain disruption mentioned, some indicators suggest potential issues. The decrease in amount due from related parties, page 291, may indicate a problem with cash flow or payment terms. However, these indicators do not necessarily point to a full-blown supply chain disruption. That concludes the financial summary for WEICHAI Power. Feel free to comment below, and I will be happy to answer them when possible.